Hello everyone, I am Michael Ruger. I am the managing partner of Greenbush Financial Group. Inflation has been the story this year for the markets. I'm filming this as of May 2022. We just got a new inflation number for April yesterday, and the news, the analysts, investors seem really super focused on, has inflation peaked? Has it peaked yet? Is it going back down? And I truly believe that they are asking the wrong question. Well, while it would be nice to know if inflation is going to keep going up, I think the more important questions that investors should be asking themselves is, can we get inflation down to a level before the end of the year that will not derail the consumer? That is the key piece in all of this. The issue with answering that question accurately is the inflation picture has become a lot more complex as we've gone further into 2022. It was consensus believed at the end of 2021 that it saw the inflation pressure, but expected to be mostly associated with supply chain constraints, meaning once supply chain got back online and more stuff got on the shelves, then prices would gradually come down. But now it's become more complex because it's not just about supply chain. The Russia-Ukraine conflict has pushed the price of oil up over $100 a barrel for multiple months. We now have tight labor markets. We have wage growth. We have corporations announcing earnings, but now they're starting to soften their outlook. And then you have Fed policy. I would argue that a number of these inflation drivers that I just listed are actually more meaningful to the drive higher in inflation than supply chain by itself. And I'm going to go through with you some of the trends we're seeing in those various inflation drivers, as well as what is the likelihood that this inflation trend may tip us into a recession. First, let's talk about the Russia-Ukraine conflict and the impact on inflation. So while it's impacted lots of different supply chains around the globe, none is larger to the US than the price of oil. So while we do not import a lot of oil from Russia, it just impacts the global price of it. And if oil stays over $100 a barrel, which it has for most of the year, it's going to be really difficult to bring inflation lower, because when you talk about bringing supply chain back online and all those goods have to be put on ships and planes and trucks, all which consume oil and gas, like it's going to continue to push that price pressure higher onto the consumer. And you would think, well, since the price of oil is so high, wouldn't these oil companies be bringing more supply and production in the market to make more money? They're enjoying their lofty profits right now. They're making a lot of money, and it costs money to bring more production online. And they realize if there's some type of peace agreement between Russia and Ukraine, that could cause the price of oil to drop dramatically, so they're just enjoying the profits. I've received the question a few times, do you foresee potentially the price of oil going higher? It actually could, mainly because China's demand for oil over the last few months has decreased due to their COVID constraints, but the price of oil has remained above $100 a barrel. So if you think about supply chain constraints, plus all of a sudden China's production coming online and demanding more oil, and in the US economy we're getting a travel season, which is a higher consumption period of gasoline and oil, that could push the price even higher than it is today. Of course, the market would want to start seeing the price of oil come down, but if it does, we got to make sure it's coming down for the right reasons. If there's some type of peace agreement between Russia and Ukraine, which tables some of those risks and brings more supply into the market, that could be welcome news. But if we just see the price of oil dropping and we haven't had that peace agreement, it may be because global demand is dropping because inflation is starting to take its toll on the consumer. They're purchasing less goods. So while that helps inflationary pressures, it doesn't help the outlooks for the markets. The next inflation factor I'm going to talk about is what I consider the big one. In the US, there are 5.9 million unemployed people. And if you look at this chart, this is a chart of the number of job openings. There are actually 11.5 million job openings. So we're at a point where we're at 2 open jobs for every 1 person looking for work. And supply and demand says that if you have more jobs than people looking for work, what's going to happen to wages? Wages are going to have to go up. Right now, wage growth is growing by about 6% per year in the US. And the last time we saw a figure that large was actually back in the 1970s, which not so coincidentally was when we had hyperinflation. And it makes sense because, if the government gives you a stimulus check and you go out and buy more stuff or you can pay higher prices, that will fuel some inflation in the short term. But once that money's spent, it's spent. But if you switch jobs and all of a sudden you're making an extra $30,000 per year, now you can pay higher prices this year, next year, and the year after. It creates sticky inflation. Again, going back to the simple rules of supply and demand, the only way to really turn this trend is to get rid of those excess jobs, which means companies hire employees, they have to pay them higher wages. They pass on those additional costs to the consumer in the form of higher prices. Prices go up and up and up until the consumer can no longer afford them. Now things are starting to contract and the employers get rid of those open positions and unfortunately usually start laying people off. It's not a fun cycle to go through. One of the overarching themes that the Fed has had this year is, hey, we have to raise rates to fight inflation, but we think the economy is strong enough to absorb those rate hikes. Now, it seems like up into the first quarter of this year, that has been correct. The consumer was out spending. It showed up in the corporate earnings numbers because a lot of the corporations that are in the S&P 500 beat earnings, but on those earnings calls, those companies also started to acknowledge the impact of inflation on their input costs, which are causing prices of their products to go up, as well as they're starting to see signs that the consumer may be softening. Prior to Q1, they said, hey, the consumer could both travel and buy stuff. But now that prices have gone up, some consumers are stuck in between, well, now do I travel or do I buy this? Like they're having to give something up. Now let's address the big tech stock sell-off in the NASDAQ. So as of May 9th, the S&P 500 is down about 16%, but the NASDAQ, where most of these tech stocks live, are down about 26% this year. And a lot of this is on the back of these inflation pressures because when inflation shows up, all of a sudden the market starts caring about valuation. The best way I can explain the valuation situation is this. So if inflation is going up by 8% over the next year, and I give you the option of taking $1 from me today or $1 from me a year from now, you would opt to take $1 today because if inflation goes up by 8% and the cost of everything goes up over that 1 year period, that $1 a year from now is gonna buy you less. And that's exactly what's happening in the tech market. The market uses something called a PE ratio to determine how cheap or expensive a stock is. And it's a simple formula. You take the price of the stock and you divide it by its earning per share. So 1 year's worth of forward earnings on a stock. So if let's say the price of a stock is $100 and they're expected to make $100 per share over the next year, it would have a PE of 1. It's not uncommon in the market for stocks to trade at 10 times their forward earnings or 15 times their forward earnings. But when we look at growth stocks and tech stocks, many of them trade at much higher multiples, like maybe 30 times or 60 times or maybe even 100 times their forward earnings because they have little by way of earnings right now, but it's really the future or growth story that you're buying into. But if you have to go out, let's say 100 years worth of earnings and say, hey, $1 today is worth more, and then I have to discount each of those 100 years, I have to walk back the value of those stocks that have those very high PEs versus the stocks that may be only trading at 10 years worth of future earnings. They have to be walked back less, which is why their price may drop less. Fed policy is next. So it's the Fed's job to keep inflation under control, and they have a difficult job ahead of them. And at the beginning of the year, they kind of described it as we're trying to engineer a soft landing. I mean, we're going to slowly increase rates, maybe slow down the economy a little bit so prices come down without throwing us into a recession. So I think engineering a soft landing might be the best way to describe it. But now with all these other variables we talked about that are now driving inflation that weren't there at the beginning of the year, I think soft landing really doesn't do it justice. It's more like they're trying to thread a needle while the needle is moving and their job has become much more difficult. The market is having a very difficult time determining whether or not the decisions the Fed is making are right or wrong. I mean, they came out in their May meeting and as expected, they raised the Fed funds rate by 50 basis points. And during the minutes, they kind of said, hey, but 75 basis points is not on the table right now. The market cheered that because it felt like it had some breathing room. Market went way up that day. And then the next day, it took away all those gains and went lower because now all of a sudden the market's worried they're not moving fast enough. So the Fed ends up in kind of this no-win scenario that I raise rates too quickly, I stifle out the economy, I don't raise rates enough, inflation surges higher, so then they're in this very difficult limbo right now. Investors, when they're talking about strategies, just really have to understand it's not necessarily just about the peak. It's about how quickly can they bring it down. I mean, they announced the April inflation numbers yesterday. We got 8.3, which was less than the 8.5 in March, so inflation may have peaked, but if we only go down by 0.2 every meeting and inflation is still above 6% by the end of the year, that is probably not going to be enough to keep the economy out of a recession going into 2023. The market is going to need to see meaningful progress over the next few months to really regain faith that the Fed is on the right path. Now, I'm starting to hear things like this time it's different, or we've never been here before. There is one thing about this year that has been different, and really it's correlation between stocks and bonds. If you look back at this chart, since 1980, essentially you see all these downticks in the S&P 500, but what you see in the next column is these are the returns of the Ag Bond Index. So normally you have stocks down, bonds up, where if you look at what's happened so far year to date in 2022, S&P is down about 16%, and the bond market's down about 10%. So there's been very few places investors have been able to hide. Overall, this has been a very difficult market to make, even 3 and 6 month forecast, because like everyone else, we're watching all the inflation data come in, but really watch those driver of inflations that we talked about so you can determine whether we're making meaningful progress or we just happen to get a good number 1 month, but it's going to keep surging forward because the drivers of inflation really haven't let up. Investors are just going to really have to be on their toes this year. I hope this was helpful. If you have any questions, please feel free to reach out to me at moneysmartboard.com. Thank you.